Hello, welcome everyone. Today we'll discuss business law for chapter 10 for business organization. This is owned by McGraw-Hill 2022. In terms of copyright, this book is owned and prepared by and slide by John Piccolo, Niagara College. So let's start this class. There's quite a number of learning objectives we can start. 7 of them. Number 1, understand the various form of business, organization, and carrying on business. Number 2, explain the nature of carrying on a business as a sole propriety. And then number 3, explain the nature of joint venture. Number 4, explain the difference between a general partnership and a limited partnerships. Number 5, explain the nature of corporation and the advantages and disadvantages of this form of business organizations. Number 6, describe the role of shareholders, directors, and officers of corporations. Number 7, describe the franchise agreement. Let's start what it is. Sole proprietors is a business operated for profit by the individual who is responsible for the debts and liabilities, while partnership is a legal relationship between two or more persons carrying on a business for the purpose of earning a profit. Joint venture is a business activity usually for specific project over time, carried on two or more parties according to the terms conditions set out in the contract. What is sole proprietorship? Alright, sole proprietorship is a fairly simple form of business organization that is used when an individual owns a business or is solely responsible for its operation. Relatively easy to set, owner makes all decisions and receives all the benefits. The problem with the sole proprietor is that it has an unlimited personal liabilities. Okay, one disadvantage is the individual is personally responsible for the debt and for the business. Profit are taxed as personal income in the hands of individual as their personal tax rate. A good example: if I open up a samosa shop and then the customer has a food poisoning, the customer can sue me up to my personal asset level. So that's no good. That's the most disadvantage. Okay, let's look at the next one. Joint venture. Joint venture is a business activity, usually it's for a specific project or a time period that is carried on by one or two more business, right? And then it has equity. Joint venture is a separate legal entity created such as corporation or partnership with each party contributing to capital, asset, or participating in control through ownership interest. When I started my online business and as well as my consulting business, for BMO as well as RBC, I use as a corporation as Arahat Capital Incorporated. I'm the sole owner, excuse me, of that company. But I'm not doing a joint venture. But if I want to do joint venture, I have to do joint venture with somebody else. Okay? Contractual joint venture is based on the written contractual arrangement in which party address issues such as capital condition and financing, arrangement concerning the management of operations, allocation of profit and loss, and dispute resolution procedures. Okay? Partnership is a legal relationship between two or more persons carrying on a business for the purpose of earning a profit, such as general partnership and limited partnership. What is the partnership? General partnership. Its the advantage of general partnership is the simplicity and informality involved in using it to organize a business. A disadvantage is that a partnership may be established unintentionally by the parties with all the responsibility attached to being a partners. Number 3, legislation set out the rights of duties and of the partners, the right to share equally in the profits of the business, equal say in management decisions, and partners will automatically dissolve upon the death of bankruptcy or partners. Partnership agreement among all the partners in which such issue and management and procedure for carrying on the business, the division of profit and condition and distribution are addressed. Okay. Partnership is not a separate entity from the partners. Income is always allocated to individual partner according to their percentage interest taxed at the partners as personal rate. Okay. Let me just go back. Number 6. A partner is an agent for the other partners, and consequently, a contract is signed by one partner is binding to all partners. Each partner is personally liable for the debts, actions, and obligations of the other partners to an unlimited degree. This liability is called joint and several. Partners number 7. As an agent with each other, partners have fiduciary duty that requires them to act in the best interest of the partnership. Partners must disclose any conflict of interest, must not compete with the partnership, must not take personal advantage of information that become available to partnership. Limited partnership consists of one general partner that is liable for the debts obligation of the partnership to an unlimited degree, or at least one limited partner whose liability is limited to the amount contributed to the partnership business. The limited partner may not take part in managing the business. What is LLP? Limited Liability Partnership. It is principally for providing professional service such as accounting or legal service, mostly doing by accountant, by legal service or lawyers. Partner remain liable for their own negligence and wrongful action, but not for the negligence and wrongful conduct of the other partners. Okay. Corporation. This is one I usually to say. That's why I used to set up when I was a consultant as a for BMO and RSA. Corporation is a distinct legal entity created by a government statute with legal liability of natural person. A corporation may own land, borrow land, money, or carry on a business, and be sued its own right. Shareholders have limited liabilities. The incorporated documents shall by corporation's purpose such information as the number of directors and types of shares will have a letter of patent, article of association, article or incorporation as well. Question number 3. There are several procedures steps for incorporation: the election of the approval of a name, selection of the directors, completion and filing of the incorporated documents. Every corporation must have a name that is registered with the government. Corporation number 4, share ownership interests in the corporation are held by shareholders, such as, that's the one, and common shares have the right to vote on the certain corporate matters and to receive percentage shares of the residual property of the corporation on its dissolutions. Okay, there's also a preferred shares have a priority or over other classes of shares in terms of certain corporation actions such as payment and dividends. Dividend payment distribute the profit earned by corporation on its business activities to its shareholders with the payment based on the number of shares held. If you have 50%, then you get 50%. You get 40, you get 40% out of the profit. Okay. Shareholders' right, ownership and management. Okay. Shareholders mean the shareholders own a corporation, but not the business or the asset of the corporation. The shareholders' liability is limited to the amount invested in the purchasing of the shares. Shareholders' right, ability to vote in the annual election of directors, to inspect certain corporate records, to prove the financial statement and the company annual report, and then to share the breakup value of the corporation upon its dissolutions. For the directors and officers, the directors and corporation are responsible for managing the business. Management of the company is separable from the owners. The directors must act and make decisions that are in the best interest of the corporations. Okay. Director fiduciary, it has an obligation to act honestly in good faith and the best interest of the corporation. Disclosure of any conflict as well. Interest, not taking advantage of information obtained while acting as a directors and officers, may be personally liable for employees' unpaid wages, employee sources deduction, and environmental pollutions. Shareholders agreement, a written agreement between two or more shareholders of a corporation restrict the transfer of shares to third parties, provide a formula for valuation of a shareholder's interest, provide provisions for the solutions of the dispute, and establish a condition that allow one shareholder to buy the other one in certain circumstances. Private corporation is subject to a limit on its total number of shareholders whose shares are offered for sale to the public. Public corporation is sell shares to the public through a recognized stock exchange in compliance with provincial and territory securities regulation. This is what I've done in the past. So I do a lot of IPO when I was working for Nomura Securities, Morgan Grenfell, and Sigma Bata. I am still. I do a lot of IPO for like Nomura. We raised about $2.5 to $3 billion. I think it's about $2.5 billion to be exact. IPO from capital market in Southeast Asia to raise fund in New York Stock Exchange, London Stock Exchange, Yankee Bond as well, and Jakarta Stock Exchange as well as Singapore Stock Exchange. And then Unlimited Liability Corporation, which is ULC, is a type of corporation that has been structured for taxation purpose and was often used by foreign investors expanding into Canada. So this is a specialized corporation for expanding into Canada. So the VLC are personally liable for the debt of the corporation. This is no good. Okay, unlimited liability. This is, you don't want to have an unlimited liability. If you got sued, unlimited liability, you get to personal liable. Advantage corporation will include the following: limited liability offered to shareholders, the ability to transfer shares of a corporation to other parties, A corporation can easily raise funds through an equity financing by issuing shares to investors. So you can do an IPO here, you can do a right issue as well if you're already there, and you can do a private equity financing as well. Okay, and then advantage of corporation include the following. Corporation is taxed separately on its earnings, while the shareholder is taxed only on dividends when declared. The pressure of management and ownership in a corporation as well will continue to carry on business despite a death of a shareholders or directors. Disadvantage corporation include the following. The time and cost associated with corporations, the separate filing of the taxes, the recording obligation required by the regulatory compliances. Franchises is a business arrangement formed by a written agreement in which business grant the right to use its trademark, to its name, mark, and operating period to operate a similar business. Franchise, third, is the person granting the right under the franchise agreement. The franchisor is able to expand into new market. Example here is Tim Horton is owned by TDL, so the franchisor will be TDL. Franchisee is the person who received the rights from the franchisor under franchise agreement. If I want to go into Tim Horton franchise, then I will be the franchisee. I will have to buy the right to franchise. It has the opportunity to run his or her own business. Okay, like a good example is Tim Horton in Canada. Tim Horton is owned by TDL Incorporated. Okay, this is called franchisor, and I am the buyer, will be called the franchisee. The key questions here: what is the personal liability exposure of the owner of a sole proprietor? Number 2, can partnership exist without a formal agreement to create partnerships? Number 2, do all partners in limited liability have the same liability of debt? Number 4, what situation would corporation use in number name? And can individual be a shareholders or directors or officers at the same time? Should they? Okay. Key term 1, sole proprietorship that you need to know. A business operated for profit by one individual who is responsible for the debts and liabilities. Partnership is a legal relationship between two or more persons carrying on a business for the purpose of earning a profit. Number 2, joint venture is a business equity usually for a specific project of time or period carried on by two or more parties. And lastly, corporation. Here, a legal entity created by the government, legislation that has a separate existence from its owners. I think we have another slide. Item number 3, limited partnership consists of at least one general partner that is liable for the debt and obligation of the limited partners to a limited degree, or at least one limited partner whose liability to the amount contributed to the partnership of the business. Okay. Common shares. Common shares have the right to vote on certain corporate matters. Okay. But a preferred share have the priority over the class of their shares. So a preferred share has the number 1 priority. Number 2 will be common shares. Number 5, key terms that you need to know. Director's fiduciary is an obligation to act honestly in good faith and in the best interest of the corporation. Private corporation is subject to a limit to its total number of shareholders whose shares are not offered for sale for the public. Public corporation is sell shares to the public through recognized stock exchange and in compliance with provincial or territorial securities regulations. The franchisee is a business arrangement formed by a written agreement in which business grants to the right use of its trademark, trade name, operating procedures to operate similar business. A good example is like Tim Horton, McDonald's, Burger King, and all these things. Okay, thank you very much. I think this is the last slide. So thank you everyone. I will upload this in YouTube and provide also an Edpuzzle for your interactive learning. Thank you. Bye-bye.